have a scholarship through the Urban Land Institute. Okay? A scholarship through the Urban Land Institute. You have to be 21 as of November. Even if you're not, I would still go to these events or try to hang out with these scholars, because if anybody's interested in mortgage finance, real estate securities, banking, private equity real estate, public equity real estate, owning your own real estate, brokerage, marketing in a brokerage firm, any of that stuff, this is it. So, and then I'll give you a letter of recommendation and stuff. Okay? So if you're interested, let me know. We pretty much got through everything, didn't we? Almost everything? Didn't we? Oh, I wanted to show you something. So here's this is where I get my graphs. Stockcharts.com. I can go to bigcharts.com. If I go to bigcharts.com, they basically list, all of the news. I can go to Yahoo Finance, get some financial news. I can go to Thomson Reuters. I can go to the New York Times. I can go to Wall Street Journal. I can go to the Financial Times. I can find financial data everywhere. Okay. What you want to do is, if you later on, as you start to do more of these memos, as you read the articles, you need to be reading at least 5 articles around these asset classes. Okay. What you can do is you can find an article that has the data and the analysis in it, or has some data that you need to calculate the percentage change or make a comment about the trend or something. You can copy that paragraph, paste it into your memo, edit it, make it better, and use it without plagiarizing. Okay, that's how I would do it. And then for the graphs, you could use bigcharts.com. I personally like to use stockcharts.com. What's Apple's ticker symbol? APL. So I can go into Apple, and this is what I would do. This is exactly what I would do. Okay. Is I would go to this chart, and I would go down here to where it says range, click on it, and I go 3 years. Okay. Then what I would do is I would go down here to simple moving average. I would put in 10. Next one, I would put in 30. And then go back and get another simple moving average here. And I'd put it in the 50 goes in there. Then I would hit update. And bam, there's my graph that I'm going to use. Copy it, right copy the image, paste it in the text box, paste it in your Word doc. Boom, you're done. This is the one I like the most. Okay, this is the one I like the most. Why do I like it the most? Because the RSI, which is part of the technical analysis, is up here, and the MACD is down here. So I got 2 technical indicators right off of that. I also have the volume chart right here.
Yeah, I get it.
Volume, MACD, RSI. Basically, here's my price trend over the last 30 years. When I applied the technical analysis, I could see that this was the support, this was the resistance, this was the trading range, this was breakout to the upside. And then if I'm really good, this moving average, the 10-day, the 30-day, and 50-day moving average, when the 10-day moving average, hold on, I'm going to teach you how to make money so you don't have to rely on other people to steal your money. You can do it in your own account. Make sure nobody steals your money, okay? Because people will steal your stuff. So this is you have Apple in your stock account, brokerage account, and you're trading it. So when the 10-day crosses the 50-day, that's your buy alert. When the 30-day crosses the 50-day, that's your buy signal, you buy it. If you buy Apple, you buy it on margin, you buy the call, you write the puts. Okay, you can do that. And then, let's see, Apple price is only pretty much gone up, didn't it? Except for maybe up here and here. So these corrections right here, what'll happen is the 10-day will cross the 50-day, that's your sell alert. And then the 30-day will cross the 50, that's your sell signal. So basically what you do is you're buying low and selling high all the time. We've been doing this for a year in my investments class. I give all of my students $1 million to trade this system. They make $100,000 a year on this system. Over the last 3 years, they made $300,000 on the $1 million. They made $100,000 per year over the 3-year period implementing this moving average crossover system. It's a money machine. It works. If you believe me, do it. If you think I'm crazy, other people are doing it and making money. So either you can beat the market or you can track the market. That's where I would get the credits. And then the bullets are that you can get from the financial information in the financial pages. Oh, did you guys receive the my calculator notes? Are you going to use calculators, or are you going to do it all in your head for the exam? Are you going to do it in your head? No. So what I did was I sat down for like 2.5 hours, and I basically wrote out some calculator steps for the HP calculators and for the TI calculators. So in there it gives you the procedures in which you can use to calculate the yield to maturity on the bond, the internal rate of return, the net present value. If you still can't read my handwriting, because I have really bad handwriting, I put the manuals, I put the calculator manuals on the website, so you can use those too.
Give me a hard time.
Yeah, I have some extras. Make sure they come back to me. Okay? If there's any extras, make sure I don't have to walk around and clean up after the mess. Did anybody want, I have a couple extra copies of the extra credit problem set. Anybody interested? Solutions are up on the website. You go.
Do you hand in
I'll bring some extra.
do you hand in the hard copy or the
Yes.
soft copy?
Yeah.
Or is that?
Yeah, hard copy.
Okay.
Just if you hand in the soft copy, you might as well just print out the solution. All right, and give it to you. All right. So we got calculator, we got resume, we got memos, pre-tests. We're all on track, right? Okay, so let's do the. What I would like to do is I'd like to finish the exam today. So Monday we come in, chill, maybe do some problems, maybe look at your memos, maybe, because we're pretty much done. We're pretty much ahead of schedule. Okay. All right. So how far did we get last class on the exam? How far did we get?
You got past technical analysis.
Yeah, is that the next one? Okay. And then I think I did remember.
I don't think I picked that one out. Oh, we did. I think we did, didn't we?
Correct me if I'm wrong, I did do an introduction to the forwards and the futures and the futures on the option contracts.
Yeah.
So is there any gaps or anything? Maybe what we do on Monday is we take that for the exam. How's that sound? We do demos, we check resumes, we double check the pre-tests, we go over the exams, we work some problems. We're ahead of schedule. All right, so let's go through. So is everybody clear on the technical analysis? I've actually updated this. Everybody understands RSI and MACD. It's moving upwards. Stock prices are probably going to go up from a momentum standpoint. If they're going down, they're going down. I look at volume charts. If stock prices are going up, probably a lot of buy volume that's occurring on the volume side. If the stock price is careening down, then there's probably a lot of selling going on. So volume spikes could be an indicative of rising prices or falling prices. And usually when we get into the trading range or a consolidation phase, the trading volume dries up. So it becomes very thin. There's no information. So if there's no information, no macro or micro economic data that's coming out of the company or the economy, stock is going to trade sideways. Knowing the information hits, it's either going to break to the upside or break to the downside. can probably form another support and another resistance. And then as the information comes in, as the case of Yahoo, Marissa Mayer wasn't doing a very good job. They were missing earnings, the revenues, the hacking. So the stock got sold off. It was in a downward trend. It seemed to form another support and a resistance. And actually the support in the pricing was basically matched the resistance line years before. So it kind of set support at the prior resistance. And then it broke to the downside as basically we talked about, selling off the firm, and the firm was stock price was in a downward spiral until it formed a support using intrinsic valuation, because everybody knew that Yahoo was probably worth 26 bucks and not 14 bucks, and they basically just hung out until somebody bottomed out. I forgot what the deal was. I think it was like 22. Okay, and now the intrinsic valuation models. This is basically just the theoretical approaches to the four intrinsic valuation methods. So the first method is the perpetuity model. Very simple model. These are my notations. You want to use my notations on the exam. So the perpetuity model, I can use the perpetuity model to value either the firm or the stock. Okay, so it's a very versatile methodology. So the first is the cash flow. Well, we're not going to use last year's cash flow or this year's cash flow. We're going to project out and use next year's cash flow. Cash flows could be EBITDA, EBIT, earnings, the enterprise level, if I'm valuing the firm, or it could be EBITDA, EBIT, or earnings on a per share basis if I'm valuing the stock, the individual security. The I is going to be the discount rate that you're using. It's also considered the expected return that you want on the stock or on the firm. You can also calculate the discount rate or the expected returns using the capital asset pricing model, the CAPM. You could use the weighted average cost of capital, which we're going to talk about in the next section of the class. It can also be the interest rate on the bond. We're using the coupon here for the bond. And it can also be the capitalization rate or cap rate. If you're valuing a piece of real estate, the cash flow is going to be net operating income that you're going to use divided by the cap rate. It's going to be the value of the company. Okay? And remember that the cash flow is assumed to be constant forever. So it's a perpetuity model where your cash flow is going to remain constant forever. So the valuation model decomposes into this very simple model. Okay. The next model is called the constant growth, the Gordon growth model. It's basically the same future cash flow, but the cash flow is not assumed to be constant forever. It's assumed to grow at a constant rate. So the equation decomposes into the future cash flow, next year's cash flow, divided by your expected return minus the expected growth rate in the cash flows forever. Okay? And then from that, you're going to get the value using the constant growth of the Gordon growth model. So that's another valuation methodology. The third valuation methodology is the multiple approach. Okay? The multiple approach. So you basically take the same future cash flow and multiply it by a multiple to get the value of the firm or the value of the stock. What is the multiple? Well, if I'm valuing a company, I'm going to take the value of the company or the sales price, the selling price of a company, and divide it by the cash flow. So if I'm trying to value my firm, a startup company, well, I can project out what our cash flows, our EBITDA is going to be next year. So the question is what is the multiple, right, that I'm going to apply to our cash flow? But I know that there's been 5 deals, similar firms like ours in the last year. And I know the value in which they were sold at, and I know the cash flows. So I can calculate the multiples for those 5 companies. And I analyze those multiples, and I pick the ones that are most relevant to valuing my cash flow of my firm to get an estimated value. That's how we do it as investment bankers, okay, when we're valuing firms. I can also take the same methodology and value the stock price. So I can take the stock price future stock price divided by the future earnings per share and get the PE multiple for next year. So if I know the PE multiple for next year times the cash flow for next year, which I'm going to use earnings per share, EBITDA per share if I'm a startup, then I can get the value of the share using the PE multiple approach. So what we're going to do later on in the semester is we're going to find the multiples for the last 3 years for the top 5 banks, and then we're going to forecast out what the multiple is going to be for Goldman Sachs, which they just announced their new president today. And we're going to forecast the earnings per share for next year, and we're going to take the multiples that we projected. I've also used from the peer group, multiplied by our projected cash flow for next year, and we're going to be able to forecast the stock price using the multiple approach. If you can forecast future stock prices, is that important? Would that be something interesting? Yeah, because you're all going to be investing in stock. Sorry, it's a reality. You can't accumulate wealth by not investing in stocks. You can do it in real estate too, but everybody owns real estate, owns stock. And everybody owns stock, owns real estate. So you have to. Okay. You can also calculate the multiples, or a multiple, by using the perpetuity and the market growth model. So you take 1 divided by I is going to give you a multiple. Well, if I take that multiple and I multiply it by the cash flow, I'm going to get the same value as the perpetuity model. I can also manufacture a multiple using the constant growth of the market growth. It's 1 divided by I minus G. If I take that multiple and I divide it by that cash flow, this value is going to equal the Gordon growth value. The only thing that you're doing, this is theoretically correct. But creating multiples like this and using the multiple approach, this is the #1 method used by investment bankers and investors. They do use the discounted cash flow too, but they use the multiple. And the multiple is basically also the perpetuity and the Gordon growth when you use this. So we will be doing all of this at the end of the semester when we start doing the stock analysis. We'll put all this into the application.
Would you say this is the most trustworthy way to measure what stock price is going to be?
Not necessarily, but it is the method used. Okay, so it's basically epistemologically correct. Okay, epistemology is basically a here ideology that you conform to based off of convention. This is what's used the majority of the time by most investors. Therefore, it makes it the most relevant and not necessarily the most accurate. Okay. Any other questions? Okay, now it's the discounted cash flow methodology. Okay. In this one, I did a 3-year holding period for this one. This is how it's theoretically laid out. I have basically 3 cash flows. The first thing you need to do is you need to know what the cash flow was last year. Okay. And then grow it out to this year. And then use that cash flow for the first year. Okay, so you got to know what last year's cash flow was. Grow it out to this year, and then use that one as the first year cash flow. Okay. Then you're going to grow it out, get the second year, and then you're going to grow it out to get the third year. Then you're going to divide the first year's cash flow by 1 plus I equals 1. Second year, 1 plus I equals 2. Third year, 1 plus I equals 3. So that's the first procedure in the discounted cash flow methodology. The second procedure, this is where the students get confused, and you really need to focus on this because this is the key piece, okay, to the valuation process to get the present value of either the value of the firm or the value of the stock. Okay. So then what you have to do is you have to grow the cash flow out 1 more year to year 4. Okay. Then what you're going to do is you're going to either apply the perpetuity model or the growth approach. So you're going to take the 4th year cash flow, and if you think the cash flows are going to remain flat forever, you divide it by I. If you think the cash flows are going to grow at a constant rate forever, you divide by I minus G. What you're going to get is the terminal value. That gives you the terminal value. Then you have 2 decisions, 1 decision to make. What I can do is I can take this terminal value and I can add it to the 3rd year's cash flow and then discount it using the 3rd year discount factor. Or what I can do is I can take the terminal value and divide it by the third year's discount factor. You can do it either. I like to just add it to the third year cash flow. And then I just discount it all back to the present value. So if the present value that I come up with, either for the firm or the stock, is higher than what I can buy the company at or buy the stock at, am I going to buy it? The intrinsic value, the present value of the firm, and the present value of the cash flows for the stock are higher than the current price of the company, the current price of the stock. Am I going to buy the company? Am I going to buy the stock? Yes, because I came up with a higher value. Exactly. And if the present value is below the current price of the firm or below the current stock price, am I going to buy it? No. So what I'm probably going to have to do is I'm going to have to go back and probably reevaluate my cash flows to see if I made any mistakes. Okay? That's the 4 intrinsic valuation methodologies. Okay? Any questions on this? Yes, sir.
Can you use the discount cash flow with startup companies or no? Because you said you need a whole
You,
year cash flow.
in practicality, if you go work for a venture capital firm or a private equity firm, they will say that these two they're not going to use. And they're probably not going to use this one too. They're probably going to rely solely on the Bolton approach. But they will make you run this. To run through some scenarios, on what the growth path could be.
Okay.
So maybe you take over a company. This is what we do. We take over a company. We bring in our people. We bring in our systems. We basically restructure the company. We grow the cash flow very rapidly in the first 3 years after we took them over. And then by that time, we've increased cash flow significantly, and the buyers will also apply a higher multiple, so our valuations go through the roof. That's why these unicorn valuations are in the billions. That's why they're in the billions, because they're using really high multiples. Okay. All right, any questions? Are we covering everything? Covering everything? Am I missing anything? Any angst, any frustrations, any cognitive dissonance, any anger, any stress, frustration, sweating? Nope, okay, good. So let's do these two. These are the 2 questions on the, first 2 problems on the exam. They're basically very simple present value calculations. They're not net present value calculations. You'll be doing more net present value calculations and internal rates of return, break even. We'll be getting into capital budgeting, decision making. This is a form of capital budgeting, decision making. So we got two clients. Okay, we have 2 clients. So we got a call. We could be a sports consulting company. It could be my economic advisory company. It could be a Wall Street bank. It could be an accounting firm. It could be an agency, a sports agency. Could be any role that it's basically the same. I could be basically representing either the plaintiff or the defendant in a court case as an expert witness. I could be doing that here too. So the first case is Eric Fisher, #1 draft pick of the Kansas City Chiefs. And his agent are evaluating 3 contract options. So they hired us to basically evaluate the options. It offers a signing bonus and a series of payments over the life of the contract. Fisher uses a 10.25 rate of return to evaluate the contract. So that's his expected return. That's going to be the discount rate in which he's going to use to discount the cash flows from the contract. Now he's asked us to basically evaluate option A, B, and C. So we know that, and again, I made these in thousands. I just took out the zeros, just to make the math a little bit easier instead of having to draw it out of zeros. So he's going to get a signing bonus of $3.1 million in option A, $4 million in B, and $4.25 in option C. And then he's going to get these cash flows that are going to go out. The first contract is a 6-year contract. we know what the cash flows are gonna be, or the salary is gonna be. So we're gonna take the 10.25%, we're gonna do 1.1025 to the 1, to the 2, 3, 4, 5, and 6 to get the discount factors. And on the exam, if you could show me those discount factors, I would love you, okay? So that I know that you know how to work through the problems and do the calculations. Then you're gonna get your discounted cash flows. You're not gonna discount the signing bonus here, right? Because the equation is right, would be 1.1025 to the 0, right? And that turns out to be 1. So 3,100,000 divided by 1 is 3,100,000. Okay, so it doesn't do anything. And you're receiving this bonus up front right at the beginning of the contract. So you don't need to discount it. So then you calculate the discounted cash flows, add them up, and under option A, you would get 6,922,000, almost 923,000. Option B is going to get a signing bonus of 4 million, but the contract is only going to go out for 4 years instead of 6 years. So then you're going to calculate the discount factors, discount the cash flows, don't discount the bonus, add them together, and then option B is going to get $6,984,000. Then option C, it's a 5-year contract, is going to get 4.25 million up front. Again, we're not going to discount that. Calculate the discount factors, discount the cash flows, add them up, he's going to get basically $7.1 million is the present value for option C. So what option would you pick? A, B, or C? A, B, or C? A, B, or C?
C.
C. Then our next client is Triad Owens. He's a professional athlete, currently has a contract. That will pay him a large amount in the first year of his contract and smaller amounts thereafter. He and his agent have asked the team to restructure the contract. The team, though reluctant, obliged. Triad and his agent came up with a counteroffer. What are the present values of each of these 3 alternatives below, using a 14% discount rate? So that he must have been in a more riskier occupation than Owen, than Eric, because obviously he's using a higher expected return or a higher discount rate. Test question. When looking at just the theoretical model for the discounted cash flow, which discounted cash flows are worth the most? Year 1, year 2, or year 3? Assuming no growth rate. Which one's going to be of higher value? I have 3 cash flows going out, they're all flat. I got to calculate the present value, the discounted cash flow for each year. Which year is going to have the highest value?
Year
1, 2, or 3?
1.
Okay, anybody else? Year 1, right? Because the discount factor is smaller. Okay. So remember that your future cash flows are of a higher risk. And you have to apply a higher probability, higher discount factor, because they may not show up in the future. So your future cash flows are going to be worth less. And then what if I took out, I just looked at cash flows going out into the future? What if I went out to 30 years? What do you think the 30-year cash flow would be worth? What? Yeah, exactly, it'd be close to 0. So what happens in these discounted cash flow equations is you start off in your first year, so the discounted cash flow is the highest, and then once you get to like year 10, 20, 30 years, it reaches what is called an asymptote in calculus. So the majority of your cash flow is going to be in the first 10 years, in the first 5 years of your cash flow stream. So what you do, this is your terminal value calculation right here, is this stuff. All of this that's left over is captured in the terminal value. That's what the terminal value does. Okay. All right. And I can juice my present value. I can juice my present value. I've seen acquisitions people do this stuff. Is I can grow out these cash flows really aggressively to pump up the present value to get the project accepted. Or what a lot of my colleagues have done in the past to board members and executive investment committee members is they basically will juice the terminal value and pump up the growth rate and pump up the terminal value to pump up the present value so that they can get their project accepted. Because they get paid. They get paid based on the amount of deals that they do and the size of the deals that they do. The problem is once they retire, guys like me have to come in on the risk management team and reassess these things and figure out that they totally financially engineered the deal, and the deal wasn't really as good as they said it was going to be, and we never hit our expected returns on the project, so we got to sell it for a loss. And those guys are already in Tiburon, hanging out on their yacht. Okay. So that stuff happens too. So the second example was the 3 contracts. Basically, you set it up the same. You got the cash flows. He's using a 14% discount factor. You calculate the discount factors. You discount the cash flows. You sum them up to get the present value. And in the first current contract, it's worth $12,847,000. The team is offering these cash flows over the same time period. You calculate the discount factors, you discount back the cash flows, you sum them up, and you get 11.374, $11,374,000. So that's not a bad offer, but I told our client to counter offer and ask for these cash flows. Well, these cash flows at his expected return, you calculate the discount factors, discount the cash flows, sum them up. In the counter offer, we get them $14,519,000. So which one are we going to accept? We want the counter offer, right? Because it has the highest present value. Okay. The next question, 7.1, basically asks you, what is the value of the stock if you apply the capital asset pricing model to come up with the expected return on the stock? So the first thing you need to do is you got to figure out what the expected return is on the stock using the capital asset pricing model. Oh yeah, you look good. I could make you a star. Make you a movie star, friend. All right. So we know that the CAPM equation, to get the estimated expected return on the stock, and this CAPM equation can also be used to come up with the expected cost of the equity. It's exactly the same thing. When I'm using the CAPM to calculate the expected cost of capital, equity capital, I'm the firm doing it. And if I'm the investor using CAPM, I'm calculating the expected return on the stock. Same equation, one's from the investor standpoint, the other's from the company standpoint. Same equation, just depends on if you're an investor or if you're the company. So we know from the data inputs, we know that the risk-free rate is 3%. We know that the market risk premium, which is this, is 8%. We know that the current stock price is $64.61, and we know that the annual dividend is $1.92. Okay? So now what we do is we just plug in the numbers to the CAPM equation. So it's the beta, 0.65 times the market risk premium, 0.08, plus the risk-free rate. We get an expected return of 8.2%. Got it. Okay. Then what we do is we have to come up with the holding period return, right? Come up with the holding period return equation. And we know that that's P1 minus PO plus CFO. So this is your annual dividend. That's the stock price before, and this is the future stock price. And this is what we're trying to forecast, divided by the current stock price. So we know it. So we know what the holding period return is. which is 8.2% or 0.082. We know what the current stock price is, which is $64.61. We know what the annual dividend, which is $1.92, and we also know what the current stock price is of $64.61. So then you just apply the algebra. Okay? So you basically take this, move that over here, and that leaves you this, which gives you this equation. Then you basically take all of this, move that over here, obviously reversing the signs, to get the product of $67.99. So that's what the stock prices are. So you got to calculate the cap down. So you got to know the cap down equation, and you got to know the holding period return equation, and then you got to know the algebra to be able to rearrange it to solve for the future stock price. Any questions on that? No? Yes? Yes?
The WAC, why don't you use the WAC cap down? What's the difference?
Well, since we're buying a stock, we want to use the capital asset pricing model because you're buying an equity share. The stock is an equity, so you're using the equity cost of capital. Okay. If I was, let's say I'm IBM, and I want to buy Oracle, I'm going to use the weighted average cost of capital to come up with the value of Oracle stock, okay? Or come up with the value of Oracle. So it depends on, if you're an investor, you're using CAPM. The weighted average cost of capital has CAPM in it, okay? So it's a component of the WACC, okay? Any other questions? Do you guys have any questions, clarifications? All right, any other questions? And then the next one is the bond price calculation. So this one is a BA Corp issuing a 10-year bond with a coupon rate of 8%. The interest rate for similar bonds is currently 6%, assuming annual payments. What is the value of the bond? Is it annual payments or semi-annual? Is it annual or semi-annual? Is what? Is it annual or semi? What? It's annual. Okay. If it was semi-annual, what would I do? If this asked you to basically price semi-annual bond, what would you do?
That basically doubles the number of periods, right?
Yeah, I doubled the amount of periods and also do what?
I think it's like halving the interest rate.
Yeah, and then divide the coupon interest rate by 2. Got it. So that's how you would do the adjustment. The $1,000 premium that you return at the end of the period stays the same. You don't touch it. Okay? All right. So they ask you to price this bond. So you could go out 10 years and do the discounted cash flow on this thing. You already know what the coupon is. The coupon payment is 1,000 times 8%, which is $80 a year. So I could have gone out, 8 years, right? I could have gone out 10 years, have the $80 as the numerator go out 10 years, and the 10th year I'm going to receive my $1,000. I could have discounted it back to the present to do the valuation calculation. I can do that. Or I can use the equation, which is basically the annuity calculation, the annuity formula, where I take 1 divided by 1.06, 1 divided by 1.06 to the 10th power, minus 1 divided by 0.06. That's going to give me $588.81. Then I'm going to take the $1,000 I'm going to get in year 10, and I'm going to discount it back to the present. So 1,000 divided by 1.06 to the 10th power is going to give me the $558.39. I have the present value of the coupons plus the present value of the premium, and I'm going to get the value of the bond of $1,147.20. Is this bond trading at a premium, par, or a discount? 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 Premium. So when the bond trades at par, it's trading at $1,000. I just ask the questions over and over again until I get the right answer. And it drives my students crazy. It comes up every semester in my evaluations. So it's trading it's trading even after all the cake and cookies I give you guys. I still get harassed. So it's trading at a premium. Okay. Any questions on that? And why is it trading at a premium? Test question. Why is it trading at a premium? Test question. And it leads right into the next question. Why is this bond trading at a premium?
Because the bond rate 4 to 8%, while for similar bonds would be 6%.
Oh no, you are just like on fire, man. You're amazing. That's exactly right. The market interest rate, the coupon interest rate is higher than the market interest rate. So it's giving you a higher return on the coupon. So when the coupon rate is higher than the market rate, the bond is going to trade at a premium. When the market rate equals the coupon, the bond is going to trade at par. It's going to be $1,000. And when the market rate is higher than the coupon rate, the bond is going to trade at a discount. So you need to write that down. Okay? You need to write that down. Because in the future, when you see these problems, you're going to know, oh, look, that corporate bond is trading at $800. Well, the coupon interest rate must be below the market interest rate, so it's trading at a discount. It's trading above 1,000. Oh, it looked the bond's trading at $1,100. Then obviously the coupon interest rate is higher than the market rate, so it's trading at a premium. Got it. Okay. So that's basically the calculation there. Oh boy, oh my goodness. This next question, 810, is the yield to maturity. Okay, the yield to maturity. So you got a couple things here. What's the price for 8.10? What's the price of the bond? $868.43. Is it trading at a premium or a discount? Right there on the page. Look it up. You guys should be following along and writing notes. So is the bond trading at a premium or a discount?
Don't know.
It's currently the price of the bond is how much? $868.43. Is it trading at a premium or a discount? Is it trading at a premium or a discount? It's priced, I just went through the lecture like a second ago. It's trading at a discount. So is the market interest rate higher or lower than the coupon interest rate?
Higher.
So the market rate is higher.
The market rate is higher, so the bond is trading at a discount. So the market interest rate has to be higher than what? It's right here on the page. It's going to be higher than what? 6%. Exactly. Okay. So what I can do, is I can lay out, is it semi-annual or is it annual? What's the term? 4 years, so 8 periods. So I could set up 8 periods. Okay, I'm going to take the coupon rate. Do we know what the rate is? $30. Oh, semi-annual. So it's 6% divided by 2 times the 1,000 is going to give me $30. So that's my semi-annual. So I could set up the $30, right? 10 years. Or how many years? No, 8 periods. $30 each. That's the numerator. Plus, don't forget, in the 8th year, I get my $1,000 back. And then I'm going to divide the discount factors are going to be what? What am I using to discount this? Oh, we don't know. We have to come up with that. We know it's greater than 6%. So what you can do is you can take those calculator steps that I gave you, and you could basically calculate the yield to maturity on the bond, which is going to give you the market interest rate. You can do that. Or what you can do is you can take those $30, and you can try it at the 7%, the 8%, the 9%, the 10%, right? Semi-annual discount factor, until you get to the $868.43. So that's going to, so you start taking up the discount rates. That's going to take down the bond prices, And once the bond price matches, the valuation, the bond value that you come up with matches the bond price, whatever discount factor you're using, that's it. That's the market interest rate. That's the yield to maturity. So you can do it either way. You can either lay it out on the exam, just show me 8 periods of $30 each, you know, with the semi-annual discount factor, discount the cash flows, and tell me what you get. I don't care if it's $868.68. I don't care what the value you come up with, just as long as you know that since it's trading at a discount, the market interest rate of the yield to maturity has to be higher than the coupon. So you apply a higher a higher discount rate, and then you calculate it. So you can show it to me, or you show me the calculator steps. Okay, is everybody clear on that one? Okay, and I don't care if you use 7%, 8%, 9%, or 10%, I don't care. Just show me you know how to do it, or you know how to do it with the calculator. Okay, and then the constant, how much time do we have?
20 minutes.
Okay, perfect, so we'll finish this. So the next one is the constant growth model. So Maury Band Corporation paid a dividend of $2.15 yesterday. The company's dividend is expected to grow at a steady 5% for the foreseeable future. If investors in stocks of companies like Maury Band require a rate of return of 15%, what would be the market price of Maury Band? What model are we going to use for this? What model are we using? What? Gordon Road, exactly. Okay. So we know that P equals D1 I minus G. Got it. Price is also D01 plus G divided by I minus G. Got it. So to get the price, we know what the dividend is, 2.15. We know it's going to grow out at 5% forever. We just grow it out. And then we know that the expected return is 15%, and we know that the constant growth rate is 5%. We just do the mathematics, do the calculations on the exam. And the stock price is going to be $22.58. Do me a favor, do not come in and just write the answers on the exam. Do you think I've had that happen before?
Probably.
Yeah, it's happened. And who's going on Thursday next week? Who's presenting? We have 2 more chapters, 8 and 9.
We're 8.
Perfect. Cool. Those are 2 of my favorite chapters. Okay, so let's do the last one. Okay, this is the non-constant growth. Staggered for paid dividends of $5, $6.25, $4.75, $3 the next 4 years. They just gave it to you. They didn't give you the growth rates to grow them out. They gave you a really simple question. Therefore, management expects the dividend growth rate to be constant at 6%. The required rate of return is 18.5%. What is the current value of the stock? Got it. So, we know the dividends. $3, we got to come up with the terminal value. That's what we're missing here. This is 1.185 to the fourth. 1.185 to the third. 1.185 squared. And 1.185. Don't forget in the exam, calculate the discount factors, and then show me the discounted cash flows. So show me that additional step. So this decomposes 4.22. This one decomposes to 4.45. This one decomposes to 2.86. And this one, we're missing one. Okay, so how do we calculate the terminal value? Okay, so we know we're going to get price for the terminal value for year 4. We know that the dividend in year 4. Okay, hold on a second. So P4 is D5 divided by R minus G or I minus G. Okay, so we're going to get that calculation. So what I need to do is I need to take the 4th year's dividend and grow it out one more year. So I got $3 times 1.06. Got it. And then it's going to be 185 minus 0.06. So I'm going to take the same discount factor and I'm going to subtract out the constant growth rate, but I've got to grow the 4th year cash flow out to get the 5th year. Okay, same thing as over there. So this is the terminal value. And the terminal value comes out to be $25.44. So I'm going to plug that in there. Got it. And if I discount that back, I'm going to get $14 and 42 cents. I add all of these things up. I get a current stock price using the Gordon growth and the constant growth model of $25.95. So if the current stock price is $20, am I going to buy it? Will I give a buy recommendation? It came up with a present value of $25.95. The current stock price is trading at 20. Am I going to buy it? Hello? Am I going to buy it?
No.
Yeah. Test question. Any other trade recommendations that you would make? You were an investment advisor and you were doing the securities analysis on this stock, or your company or one of your clients asked you to do evaluation on the stock to see if they should buy it. Would there be any other trade recommendations that you would make to your client? We've already gone over this like 3 times. No, you're getting close. You're close now. What would be the other trades that I would use? I could, but let's just focus on the stock trades. What?
Buy puts.
Okay, anybody else? What would be the, do you buy puts when stock prices are going up? I'm going to do what? I can write puts. Great. What else can I do? You can look at your memo, you can look at your notes, you can look at your notes, you can look at your memo. It's pretty easy. We're going over stuff over and over again. I can buy calls. I can buy a margin. Is that correct? Yep. And what if the current stock price is $30? Current stock price is $30, and I'm coming up with a value of $25.95. We make the recommendation to sell. What else?
Sell on margin.
There's no such thing.
Right.
You buy a put. It's on your memo. It's in your notes. Right? This is going to be on the exam. Right? It's on the exam. You got to memorize this stuff. What else did you do? Sell. Buy puts. It's really easy. easy, that's all you gotta do is go look at your notes or look at your, the memo templates that I gave you. The final ones were, you anticipate the stock price going down, you can just read it back. You have all the notes, you have all the answers.
Right calls.
My calls. Reconciliation. Done. That's it. We're done.